Gulf aviation in crisis, geopolitical tensions spark massive airspace closures and traveler chaos. Compiled by televangelist H.B. Morgan. The Gulf region, long considered the bedrock of global aviation connectivity, is currently grappling with a severe logistical crisis. Escalating regional tensions marked by missile and drone activity linked to Iran have forced several states to abruptly shut down or restrict their airspace. The result is a wave of cancellations and delays that has left thousands of international travelers stranded in major hubs like Dubai and Doha. Hubs under pressure. Dubai International Airport, DXB, and Hamad International Airport, DO, typically two of the most efficient transit points in the world, have been transformed into scenes of frustration and uncertainty. Following a series of security alerts, major carriers including Emirates and Qatar Airways were forced to suspend numerous routes and overhaul their flight schedules. For many passengers, the wait has exceeded 48 hours. When boarding announcements are finally made for cleared flights, the atmosphere in the terminals shifts from exhaustion to relief. With crowds frequently erupting in spontaneous cheers as the first signs of movement appear. The search for alternative routes. With direct paths blocked, travelers and travel agencies are being forced into a high-stakes gamble to find a way home. This has led to a surge in demand for creative, albeit much longer, itineraries. Common workarounds now include indirect transit routing through neutral hubs like Istanbul or New Delhi to bypass restricted zones. Overland travel. Some passengers are attempting to cross borders by land into neighboring countries to catch flights from outside the immediate conflict zone. European rail routing, utilizing European cities as secondary hop points for those trying to reach the West or Africa. This scramble has caused ticket prices for available seats to skyrocket, placing further financial strain on travelers who are already facing mounting hotel and meal costs as airport adjacent accommodations hit full capacity. Economic and logistical fallout. Beyond the immediate human impact, aviation analysts are highlighting the systemic vulnerability of the global travel network. The Gulf sits at the crossroads of the world, and even temporary airspace closures ripple across the globe, affecting flight paths from London to Sydney. For airlines, the crisis represents a significant operational challenge. Rerouting flights to avoid sensitive areas often adds several hours of flight time, leading to increased fuel consumption and higher operational overhead. If these tensions persist, the industry may see a more permanent shift in how transcontinental routes are managed, potentially leading to long-term increases in airfare. A fragile recovery. While some flights have begun to depart, the situation remains fluid. Aviation authorities continue to assess security risks in real time, meaning that a route cleared today could be closed tomorrow. For the thousands still waiting in terminal lounges, the journey home remains a test of patience and resourcefulness as the world watches to see how the geopolitical landscape will further impact the future of global travel. Courtesy of Business Leadership Occupational Growth, BLOG Academy Publications.
Supply crisis. India's MRPL forces partial shutdown as Middle East tensions choke oil flow. Compiled by televangelist H.B. Morgan. Mangaluru. In a stark sign of growing pressure on the global energy supply chain, India's state-owned Mangalore Refinery and Petrochemicals Limited (MRPL) has been forced to take several refining units offline. The move comes as a direct result of a critical shortage of crude oil, triggered by escalating geopolitical volatility in the Middle East. According to sources familiar with the operations, the shutdown began on Wednesday evening and has impacted a significant portion of the facility's 300,000 barrel per day (BPD) capacity. Specifically, a 100,000 BPD crude processing unit and several secondary units, including a vital hydrocracker, have been suspended. The Hormuz bottleneck. The primary driver behind this sudden supply crunch is the intensifying disruption in the Strait of Hormuz. As a key transit point for nearly 20% of the world as crude, the strait has become a flashpoint for Iran-related security threats, rattling shipping lanes and delaying vital deliveries to Asian refiners. MRPL is particularly vulnerable to these regional tremors. After phasing out its reliance on Russian oil last year, the refinery has become heavily dependent on Middle Eastern imports. With cargo arrivals now delayed or diverted, the company has had no choice but to scale back operations to manage its dwindling stockpiles. Domestic impact and export halts. The ripple effects of the shutdown are already being felt in the broader market. In an effort to prioritize domestic fuel requirements, MRPL has reportedly suspended the export of refined products, including gasoline. Industry analysts warned that if the supply bottlenecks persist, the consequences could hit Indian consumers directly. A sustained reduction in output at major refineries like MRPL could tighten national fuel availability and put upward pressure on retail pump prices. A regional trend. MRPL is not alone in its struggle. Reports indicate that several refiners in China have also begun cutting production runs as they face similar challenges in securing replacement cargoes. While MRPL has not yet issued an official comment on the duration of the shutdown, the situation underscores the extreme fragility of India's energy security in the face of Middle Eastern instability. For now, the market remains on high alert as traders watch for any signs of stabilization in the world's most critical oil corridor. Courtesy of Business Leadership Occupational Growth (BLOG) Academy Publications.
Geopolitical turbulence hits UAE real estate. Can the property boom withstand rising tensions? Compiled by televangelist H.B. Morgan. The unprecedented surge in the United Arab Emirates real estate market is entering a period of significant volatility. Following recent Iranian missile strikes in the Gulf, the property sectors in Dubai and Abu Dhabi are facing a critical moment of truth. As geopolitical instability begins to weigh on investor sentiment and capital flows, a market built on stability faces a new test. For years, the UAE has positioned itself as a global safe haven, attracting a massive influx of foreign capital, wealthy expatriates, and multinational corporations. However, the recent escalation in regional tensions has exposed the vulnerability of a market that relies heavily on international demand. Market reaction was swift. Shares in industry giants like Emaar Properties and Alder Properties saw a sharp decline of approximately 5% as the news broke. Analysts suggest this sell-off is a direct reflection of fears that the international buyers, the backbone of the UAE's property boom, may pause or pivot their investments until the regional security landscape stabilizes. Key pressures on the horizon. Financial experts and real estate analysts point to several emerging challenges for the sector. Pressure on off-plan sales. Much of the recent growth has been driven by off-plan projects. With heightened uncertainty, these pre-construction sales are now under the microscope, facing higher risks of cancellations and slower take-up rates. Rising costs for developers. Increased regional risk often leads to higher financing costs. Developers may find it more expensive to secure the capital needed to break ground on new projects. The shadow of oversupply. Even before the strikes, economists were flagging concerns about a potential supply glut. With estimates suggesting up to 400,000 new units could enter the Dubai market by 2028, any dip in demand could exacerbate the downward pressure on prices. Expert perspective. The sentiment among industry veterans is one of cautious observation. Real estate investment typically relies on stability, visibility, and sustained investor confidence, noted Ryan Lemond, a wealth management executive. Without a clear path to de-escalation, the visibility required for long-term multi-million-dollar investments remains clouded. The long-term outlook, resilience or retreat. Despite the immediate shock, the UAE's underlying economic fundamentals remain a strong counter-narrative. The country continues to be a strategic hub for hedge funds and global firms looking for a bridge between Europe, Asia, and Africa. Many developers remain optimistic that the UAE's world-class infrastructure and business-friendly environment will eventually outweigh temporary geopolitical jitters. While the reckoning has arrived, the ultimate impact will depend on how long the instability persists. For now, the UAE property sector is navigating a delicate balance between its long-term growth ambitions and the immediate reality of regional risk. Courtesy of Business Leadership Occupational Growth, BLOG Academy Publications.
Big Tech and Trump set talks on power supply for growing AI infrastructure. Compiled by televangelist H.B. Morgan. U.S. President Donald Trump is preparing to host a major meeting at the White House with executives from some of the world's largest technology companies, as part of a new initiative designed to address the growing energy demands of artificial intelligence infrastructure. The gathering will focus on a proposed agreement known as the Ratepayer Protection Pledge, which aims to ensure that the rapid expansion of data centers does not result in higher electricity costs for households and small businesses. Addressing the energy impact of AI expansion. Artificial intelligence and cloud computing have triggered a surge in data center construction across the United States. These facilities require enormous amounts of electricity to operate servers and cooling systems. Concern has been mounting among policymakers and communities that this rising demand could strain the national power grid and push utility costs higher for everyday consumers. The White House initiative seeks to address these concerns by requiring technology companies to take responsibility for powering their own facilities. Under the proposed arrangement, companies would either build new energy capacity, purchase dedicated electricity supplies, or expand existing energy sources to support their operations. Major technology firms expected to participate. Executives from several global technology leaders are expected to attend the meeting. Among the companies likely to take part are Google, Meta, OpenAI, Microsoft, Amazon, Oracle, Xi. These firms are among the biggest investors in artificial intelligence infrastructure and operate vast networks of data centers that require large amounts of energy to function. Key commitments in the proposed pledge. 1. While final details are still being finalized, early reports indicate that participating companies may agree to several key measures. 2. Securing or generating their own electricity supply for new data centers. 3. Funding grid infrastructure upgrades required to support their facilities. 4. Entering special electricity agreements with utilities to prevent costs from being transferred to residential customers. 5. Coordinating with grid operators to improve energy reliability during shortages or emergencies. 6. Supporters of the plan say it could encourage private investment in energy infrastructure while protecting consumers from price increases linked to the tech sector's energy usage. Political context ahead of the midterms. The initiative comes at a politically sensitive time as the United States approaches the November midterm elections. Rising energy costs and inflation have become key issues for voters, and the administration is seeking to demonstrate that it is addressing economic concerns. By partnering with major technology companies, the White House hopes to balance continued growth in the AI industry with protections for consumers and greater stability in the nation's electricity grid. Questions about implementation. Despite support from many technology firms, some energy experts remain cautious about how quickly new electricity capacity can be developed. Building power plants, upgrading transmission lines, and expanding energy generation can take years. Analysts note that while the pledge signals cooperation between government and industry, its long-term impact will depend on whether companies follow through with substantial investment in new energy infrastructure. Looking ahead. As the meeting unfolds, policymakers, industry leaders, and energy analysts will closely watch whether the initiative results in meaningful commitments. The outcome could shape not only the future of AI infrastructure in the United States but also the broader conversation about electricity demand, energy policy, and economic competitiveness in the years ahead. Courtesy of Business Leadership Occupational Growth (BLOG) Academy Publications.
Aviation sector finds brief respite as repatriation flights begin amidst Gulf conflict. Compiled by televangelist H.B. Morgan. London, Dubai, Hong Kong, global aviation markets showed the first signs of stabilization on Wednesday as a week of intense volatility began to taper off. While the conflict involving Iran continues to disrupt one of the world's most critical travel corridors, the resumption of limited repatriation flights and the opening of select air corridors have offered investors a much-needed, albeit cautious, sense of hope. A glimmer of movement in closed skies. For the fifth consecutive day, the airspace over much of the Middle East remained a virtual no-fly zone. Major international hubs, including Dubai International, traditionally the world's busiest gateway for international passengers, remained largely paralyzed. This represents the most significant disruption to global air travel since the height of the COVID-19 pandemic. However, the silence was broken on Wednesday as several governments initiated emergency efforts to bring home tens of thousands of citizens stranded by the sudden escalation of hostilities. The United Arab Emirates has reportedly established special corridors to facilitate these movements. Initial repatriation services are currently prioritized for citizens of the United Kingdom and France, with more expected to follow as security conditions allow. Market reaction: the sell-off finds a floor. After a bruising start to the week that saw tens of billions of dollars wiped off the market value of global carriers, airline stocks showed signs of finding a floor. The aggressive double-digit percentage drops seen on Monday and Tuesday moderated as the market digested the latest developments. Lufthansa shares rose 1.7% in midday trading. IAG, parent of British Airways, recovered by 2%, following a 3-day slide of more than 11%. Qantas, while still down 2.7%, the decline was notably less severe than the sharp plunges experienced earlier in the week. Despite this stabilization, analysts warn that the sector remains deeply wounded, with many major carriers still trading at nearly 10% below their pre-conflict valuations. Logistical and economic hurdles ahead. While the resumption of some flights is a positive signal, industry executives caution that returning to business as usual will be a marathon, not a sprint. The industry faces three primary challenges. Personnel displacement: with flights grounded globally, pilots and cabin crews are currently scattered across various continents. Resynchronizing staff with aircraft will be a massive logistical undertaking once airspace fully reopens. Surging fuel costs: the conflict has sent crude oil prices soaring. For airlines, particularly those without robust fuel hedging strategies, these increased operating costs could eat into profit margins well into 2026. Cargo disruptions: the Gulf is a vital hub for global air freight. The current closure is placing immense pressure on international trade routes that were already strained by disruptions in the Red Sea. The long road to recovery. Aviation experts suggest that even a total ceasefire would not lead to an immediate restoration of schedules. Carriers must navigate a complex web of safety clearances, aircraft repositioning, and schedule rebuilding. As Wizz Air noted in a recent update, the regional instability is expected to have a lingering impact on net profits for the current fiscal year. For now, the industry remains in a state of cautious waiting, watching the skies for signs that the safe corridors might soon expand into a broader reopening of the world's most vital transit hub. Courtesy of Business, Leadership, Occupational Growth, BLOG Academy Publications.
Trump as trade threat to Spain escalates NATO spending row and Iran tensions. Compiled by televangelist H.B. Morgan. Tensions between Washington and Madrid have dramatically escalated after President Donald Trump threatened to halt all trade with Spain. The threat, made during a White House press conference, links two major strategic disputes: Spain's refusal to grant the U.S. access to its military bases for the Iran conflict and its resistance to a new NATO defense spending target. The core of the dispute. Speaking alongside German Chancellor Friedrich Merz, President Trump criticized the Spanish government for blocking U.S. aircraft from using its military bases for operations related to the ongoing U.S.-Israel campaign against Iran. He framed this refusal as part of a broader pattern of non-compliance, recalling that Spain was the only NATO member last year that did not align with the proposed commitment to raise defense spending to 5% of GDP by 2035. The president argued that economic consequences are a necessary tool to ensure allies, who benefit from U.S. security guarantees, contribute fairly to collective defense. His warning signals that Washington is prepared to use its economic leverage to enforce strategic compliance from its partners. Potential economic fallout. While Spain has not yet issued a formal response, analysts warn that a complete halt in trade would be an unprecedented step with severe repercussions for both economies. The United States is one of Spain's most significant trading partners, with billions of dollars in goods and services exchanged annually. Key sectors, including agriculture, machinery, and chemicals, would be heavily impacted on the Spanish side, while U.S. businesses could also face significant disruptions. Geopolitical context. The comments arrive at a moment of heightened global tension linked to the Iran conflict, as Washington seeks maximum operational flexibility and tangible alliance support. Diplomatic observers suggest the harsh public statement may be a tactic to intensify behind-the-scenes negotiations, aiming to prevent the dispute from cracking the broader transatlantic alliance. For now, businesses on both sides of the Atlantic will be watching closely to see if this rhetorical threat translates into policy, and whether Madrid will move to align with U.S. strategic and military demands to preserve its critical trade relationship with Washington. Courtesy of Business, Leadership, Occupational Growth, BLOG Academy Publications.